Stocks get all the headlines, right? They're the flashy, exciting part of the market. But their quieter, steadier cousin, the bond, is this absolutely massive part of the financial world. You've probably heard them called fixed income, but what does that even mean? Well, today, we're going to break down exactly how they work.
So here's our game plan. We'll start with the absolute basics. Then we'll get into the nuts and bolts of what makes a bond a bond. From there, we'll check out the main types, tackle the kind of tricky concept of how their prices change, and then wrap up with how you can actually invest in them.
So first things first, what on earth is a bond? It sounds all formal and complicated, but honestly, at its core, the idea is incredibly simple. When you buy a bond, all you're really doing is making a loan. That's it.
To put a more formal definition on it, a bond is what we call a fixed income investment. You, the investor, are lending your money to some big entity, like a company or even the government, and in return for that loan, they promise two things: to pay you back the original amount in full and to make regular interest payments to you along the way.
And that right there is the key relationship you got to remember. You're the lender. The company or the government, they're the borrower. They do this to raise money for all sorts of huge projects. A government might issue bonds to build new roads or schools. A corporation might do it to fund cool new research, build a factory, or just grow their business.
And because a bond is just a loan, it has specific terms, just like your car loan or a mortgage would. So let's break down the three key parts of this loan agreement that you really need to know.
First up is the face value, which you'll also hear called par value. Just think of this as the price tag on the bond. It's the main loan amount that the issuer promises to pay you back in full when the loan period is over. It's often a nice round number, like $1,000.
Next is the coupon rate. Now this is the fun part. It's the interest rate. This is basically your reward, the payment you get for letting the borrower use your money. So if a bond has a $1,000 face value and a 5% coupon rate, you're going to get $50 in interest every year. Simple as that.
And finally, we have the maturity date. Think of this as the loan's expiration date. It's the day when the loan is officially due. On this date, the borrower, the issuer, pays you back the bond's full face value. Your original investment is returned, and the whole deal is done.
So who exactly are these borrowers that are asking for all these loans? Well, bonds are usually grouped into four main categories, and it's all based on who's doing the borrowing. Okay, running through the big four, you've got corporate bonds, which are issued by companies. Then there are municipal bonds, or munis, from states and cities, and their big selling point is that the interest you earn can be tax-free, which is pretty cool. Then you have government bonds from the U.S. Treasury, simply known as treasuries. They're considered super safe. And last, you've got agency bonds from government-related groups like Fannie Mae or Freddie Mac.
Okay, this next part is where things get really interesting, and it's also the part that trips a lot of people up. Even though a bond pays a fixed interest rate, its actual price can go up and down in the open market before it matures.
Now, here is the single most important thing to understand about how bond prices work. You ready? Their price and interest rates move in opposite directions, always. When one goes up, the other goes down, period. The best way to visualize this is to think of a seesaw. When interest rates out in the broader market go up, the price of existing older bonds goes down. And when market interest rates fall, the price of those older bonds goes up. Let's walk through a quick example so you can see exactly why this has to happen. So imagine you buy a bond for its face value of $1,000, and it pays a sweet 10% coupon. That's $100 a year in your pocket. Great. But now let's say a few months go by, the economy shifts, and brand new bonds being issued are only paying 5% interest, just $50 a year. All of a sudden, your bond that pays $100 a year looks amazing, right? Other investors are going to want it, so they'll be willing to pay you more than the original $1,000 to get their hands on it. They'll bid up the price of your bond until its effective return for them matches that new 5% market rate. That's the seesaw in action. So with prices moving all over the place, how do you measure the actual return on a bond, especially if you buy it for more or less than its face value? Well, that's where this metric called yield to maturity, or YTM, comes in. It basically calculates your total annual return, factoring in all the interest payments plus that final repayment at the end. It's really the best way to compare the true value of one bond against another. Okay, so we know what bonds are, we know how their prices work. Now for the last piece of the puzzle, how can you actually buy them? How do you become the lender? Well, the good news is it's actually pretty easy these days. You can buy a lot of bonds through the same online brokerage accounts you'd use for stocks. If you want U.S. government bonds, you can go straight to the source and buy them from the Treasury Direct website. And probably the most common way people invest is indirectly,
through things like bond ETFs or mutual funds, which are basically baskets that hold a whole portfolio of different bonds for you.
And that brings us right back to where we started, back to that core idea of fixed income. And it's called that for a very simple reason. At its heart, a bond is designed to provide a predictable, fixed stream of income payments to you, the investor, the debt holder.
But this whole thing leaves us with a really fascinating question, doesn't it? We call them fixed income and everyone says they're safer than stocks, but we've just seen how their prices can bounce around. That price risk is totally real. But here's the thing, as long as the borrower doesn't go broke, you are guaranteed to get your original investment back when the bond matures. The price fluctuation really only matters if you decide to sell early. So it makes you wonder, what does safe actually mean when we're talking about investing, and where do bonds really fit on that spectrum?